Welcome, everyone, to the Deep Dive. Today, we're pulling back the curtain on a company that's absolutely vital to modern medicine, even if you rarely see their name on the bottle. WEST Pharmaceutical Services, they're kind of the hidden engine, providing these critical containment and delivery systems that make sure countless life-saving medicines get to patients safely and, effectively. Our mission for this deep dive is to dissect West's Q2 2025 earnings call and their financial reports. We'll pull out the crucial insights, try to understand the strategic currents driving their performance, and figure out what their future outlook really reveals. The goal is simple: get you well informed on this fascinating, often overlooked sector. How is West Pharmaceutical Services navigating this evolving healthcare landscape to really solidify its crucial behind-the-scenes role? Let's dive in. So let's kick things off with the headline numbers.
Yeah.
West Pharmaceutical Services reported net sales of $766.5 million for Q2 2025.
Right.
That's a robust 9.2% increase over the same period last year, 6.8% on an organic basis. Their adjusted diluted EPS hit $1.84. That's a notable jump from $1.52 a year ago. Clearly, they didn't just meet expectations, they sailed past them. But beyond these impressive figures, what's the real story? What's behind this strong performance?
Well, what's truly illuminating here, I think, is that the improved performance wasn't just about, selling more stuff. It was largely concentrated in their higher margin businesses.
Okay, higher margins.
Exactly. And that drove significant margin expansion in the quarter. Gross profit margin increased to 35.7%. That's up 290 basis points year over year.
Wow.
And the adjusted operating profit margin also saw a healthy increase to 20.3%, up 230 basis points.
So this tells us they're not just growing, they're growing profitably, focusing on their most valuable offerings.
Precisely. It's about profitable growth.
And what specific areas were the main engines driving that profitable growth?
So the key drivers were solid growth in what they call high-value product, or HVP components.
Right, HVP.
We also saw robust demand for GLP-1 elastomer products, continued momentum in HVP conversions linked to that Annex 1 activity we'll probably talk about.
Okay.
And crucially, the normalization of customer ordering patterns after some earlier destocking in the supply chain.
Ah, that destocking finally eased up.
Yes, exactly. That was a key piece this quarter. Things seem to be getting back to, let's say, a more normal rhythm.
Okay, let's unpack this high-value product segment then. That really sounds like the core of their strength and profitability.
It absolutely is. The proprietary products segment, which makes up a massive 81% of total company net sales.
81%.
Yeah, it grew 8.4% organically in Q2. And within that, HVP components were particularly strong, increasing 11.3%.
Okay.
And they represent 47% of total company net sales now. This is really where West's deep expertise and specialized materials, really shine.
You mentioned GLP-1 elastomers. Now, given the, explosion in demand for GLP-1 drugs for diabetes and weight management, how significant are they becoming for West? And what does their growth say about West's strategic agility?
That's a critical point. GLP-1 elastomer products accounted for 8% of West's total company revenues in Q2 2025.
Yeah.
That's up from 7% last quarter.
Just one quarter, okay.
Yeah. And what's truly remarkable isn't just a sheer demand, but how West strategically leveraged investments made during the pandemic, initially for vaccine production capacity.
Right, I remember that push.
To pivot quickly and capture this new explosive wave of GLP-1 demand. It really speaks to their foresight and ability to adapt existing infrastructure.
That's smart.
Very. They're seeing this growth across multiple GLP-1 drugs, specifically for components like plungers and vials.
And what about these Annex 1 related revenues? For our listeners, that sounds like maybe a compliance term, but it seems to be a significant long-term growth driver. What exactly is it, and why is it so important?
It is a significant multi-year opportunity. And yeah, it goes far beyond just compliance. So for listeners, Annex 1 refers to the updated EU GMP guideline for sterile manufacturing. It basically introduces increasingly stringent quality and safety standards.
Okay, higher standards.
Right. And West now has 370 Annex 1 HVP upgrade projects underway, up from 340 last quarter.
Quite a jump.
It is. These projects are essentially helping their pharmaceutical clients meet these new, tougher standards, often by converting their existing drug formulations to higher quality levels. Think processes like pharmaceutical washing, vision inspection, sterilization.
So it's about quality upgrades.
Exactly. This isn't just regulatory adherence. It's about West solidifying its position as a go-to partner for future-proofing drug production. They are often the incumbent supplier on these commercialized drugs, and crucially, they can deliver this enhanced quality at scale.
Makes sense.
They anticipate about 150 basis point contribution from Annex 1 in 2025 alone.
That's a clever strategic move, converting existing business to higher value, probably stickier revenue streams.
So what does this all mean for other parts of their proprietary product segments, like, say, biologics or generics?
Well, the biologics, pharma, and generics market units all delivered high single-digit organic net sales growth, too. So pretty solid across the board.
Okay.
In biologics and biosimilars, West's participation rate is actually trending above historical levels so far this year, and their win rates for small molecules remain in line with past trends.
Good consistency.
Yeah. There are still some lingering destocking headwinds in generics, and maybe to a lesser extent in biologics, but broadly, like we said, ordering patterns are turning back towards normal. This diversified strength means they're not, solely reliant on just one fast-growing segment like GLP-1.
Right, diversification matters. So it's clear their core proprietary components are, well, firing on all cylinders. But West isn't just making parts. They're also deeply involved in the delivery of these medicines and contract manufacturing. What's the story there? Good point. The HVP delivery devices business, which is about 13% of total company sales, saw a substantial 30% revenue increase in Q2.
30%. What drove that?
The majority of that growth was driven by strength in their Daikyo Crystal Zenith containment and administration systems.
Crystal Zenith. That's the advanced polymer, right? Not glass.
Exactly. For those unfamiliar, Crystal Zenith isn't just another container. Its advanced polymer material offers superior chemical inertness and breakage resistance compared to traditional glass.
Which is critical for sensitive biologics.
Critical. And now, increasingly, for the next generation GLP-1 drugs where stability and patient safety are absolutely paramount, West's exclusive partnership here gives them a real edge, particularly, they noted, due to customer demand on a specific drug launch using CZ.
Interesting. And what about their Smart Dose platform? That's their wearable self-administration system.
Yeah.
What's the strategic path forward for that?
Yeah, Smart Dose. West is actively evaluating the best path forward there, closely managing its cost base to ensure efficiency. They're also in the process of introducing a new automated line in early 2026.
Right.
That's expected to significantly enhance its economics and, importantly, its scalability.
And for contract manufacturing, where they actually make devices for other companies.
Right. The contract manufacturing segment experienced a, let's say, modest 0.5% organic revenue increase.
Okay.
This was primarily driven by the initial ramp-up stages of their Dublin facility. That's where they manufacture auto-injectors and pens, primarily for the obesity and diabetes market.
Makes sense, tying into the GLP-1 trend again.
Exactly. Though that growth was partially offset by lifecycle management of a CGM, a continuous glucose monitoring diagnostics device. Looking ahead, they expect contract manufacturing organic revenues to increase low single digits for the full year 2025.
Okay. So with such a strong Q2, what's West's updated outlook for the rest of 2025? And how are those global factors like currency and tariffs shaping that guidance?
You guessed it, they raised guidance. Based on the Q2 performance and a more favorable foreign exchange environment, West is increasing its full-year 2025 net sales guidance. The new range is $3.040 billion to $3.060 billion.
Up from prior guidance.
Correct. They now expect organic sales growth to be approximately 3% to 3.75%.
And what about currency and tariffs? That's always a big factor for global companies, often a headwind. What's the latest there?
Well, the updated guidance now includes an estimated full-year 2025 tailwind of approximately $59 million from foreign exchange rates.
A tailwind. That's a big switch.
It is a significant and welcome shift from their prior expectation, which was actually a $5 million headwind.
Okay.
Regarding tariffs, they now estimate a net impact of $15 million to $20 million for the full year 2025. That's actually a reduction from their prior estimate of $20 to $25 million.
So better on both fronts there.
Seems so. They are monitoring it closely, of course, and actively using mitigation levers. It really highlights their proactive approach to these global trade dynamics.
Beyond the numbers, it's clear West is also actively shaping its future through internal changes and strategic investments. What's their long-term strategy for managing capacity and optimizing their global footprint?
Good question. They did mention experiencing some localized constraints in one of their HVP plants in Europe.
Growing pains?
Perhaps.
Yeah.
But they're proactively expanding capacity through a targeted hiring and training program there. They expect production improvements as the year progresses. Longer term, they remain confident that capital expenditures will return to a more normal level, say 6% to 8% of revenues.
Okay.
They also see significant opportunities for further network optimization through technology transfers between plants.
Hmm.
These take about 12 to 18 months.
And that helps how?
Well, it's not just about efficiency. It improves service levels for customers and can strategically mitigate potential tariff impacts by shifting production, strengthening their overall global supply chain resilience.
Makes sense. And looking at their financial health, how strong is their cash position after such a busy quarter of growth and investment?
Pretty strong. Operating cash flow was robust at $306.5 million for the first 6 months of 2025. That's an 8.2% increase, primarily due to favorable working capital management.
Good management there.
Yeah. And free cash flow was particularly strong at $160.0 million. That's a substantial increase from $92.4 million in the same period last year.
That's a big jump in free cash.
It is. And this strong cash generation allows them to invest in growth, obviously, but they also repurchased 552,593 shares for $134.0 million in the first half of 2025. That signals confidence in their valuation.
They also announced a restructuring plan earlier this year. What's the strategic thinking behind that? Is it just cost savings?
That's right. Back in January 2025, they approved a restructuring plan expected to require charges of $30 million to $32 million. But the key is it's expected to yield annualized savings of $35 million to $40 million over 24 to 36 months.
So the savings outweigh the costs fairly quickly.
Correct. And the strategic intent isn't just about, trimming the fat. It's about streamlining their global operating cost base to be more agile and responsive both to the surging demand in areas like GLP-1 and the broader shifts towards those higher value products we talked about.
So it positions them for more profitable, sustainable growth long term.
Exactly. Ensuring their infrastructure matches their evolving strategic priorities.
Okay. We also saw some big news on the leadership front, right? A new CFO.
Yes, that's significant. WEST announced the appointment of Bob McPann as their new CFO. He previously served as the CFO of Agilent Technologies.
Agilent. Okay, relevant experience.
Very much so. Brings significant expertise and a proven track record to the team. That'll be invaluable as they continue to execute this growth strategy.
And for those of you who track dividends, any news there?
Yep. The board of directors approved a fourth quarter 2025 dividend of $0.22 per share. That's planned to be paid on November 19th, 2025, to shareholders of record as of November 12th, 2025.
Okay. We also saw a mention of a legal proceeding in their filings. Can you give us some impartial context on that, just the facts?
Sure. It's important to be aware that on May 5, 2025, a securities class action lawsuit was filed against WEST and certain current and former officers.
Okay.
It purportedly represents investors who purchased common stock between February 16, 2023 and February 12, 2025. The allegation relates to violations concerning public statements about the company's business during that period.
And West's position.
WEST stated they intend to vigorously defend against these allegations. They emphasized it's still the early stages of the proceedings and reiterated the company's commitment to transparency. So, something to watch, but early days.
Got it. And finally, just a quick note about their global operations, specifically regarding their facilities in Israel, given the regional situation.
Yes, they addressed that. WEST maintains operations in Israel that conduct R&D and manufacture some components. They report that these facilities continue to operate substantially as they did prior to the conflict in the region.
Okay, that's an important operational stability note. Well, what an insightful deep dive into WEST Pharmaceutical Services. We've seen a company not just capitalizing on surging market demand, especially in those high-growth areas like GLP-1,
Right.
but really strategically strengthening its core proprietary products through initiatives like those Annex 1 upgrades.
Yeah, locking in that quality advantage.
Exactly. And they seem to be proactively navigating complex global factors like tariffs and supply chain constraints with clear plans, all while delivering strong financial results and positioning themselves for, well, long-term profitable growth.
It really does highlight how a company's success can be built on this foundation of specialized, high-quality offerings that are just absolutely critical, even if unseen, to the broader healthcare ecosystem, ensuring patient safety and drug efficacy behind the scenes.
So for you, our well-informed listener, here's a thought to maybe mull over. How might WEST Pharmaceutical Services' impressive ability to leverage existing investments like those from the pandemic era to meet current GLP-1 demand? but combined with their multi-year Annex 1 upgrade initiatives.
Yeah.
How might that reshape the broader landscape of pharmaceutical supply chains in the coming years?
Interesting question.
What ripple effects could this proactive, quality-first approach have on drug development, and maybe even the speed at which new therapies reach patients? Something to think about. Thank you for joining us for this deep dive. Until next time, keep that curiosity alive.